Wow, look at us, rock stars with mics. This is dangerous. 3 lawyers. The meter's not running. This could be dangerous. Hopefully everyone's had their coffee. We're going to kind of get into it here, make this even more interesting than it is. I'm very privileged to introduce 2 leading lawyers in Canada today to discuss 3 of Ontario's proposed new capital raising exemptions. With us today we have Mike Sharp. He's a partner in the Investment Products and Asset Management Group at Blake, Cassels, and Graydon in the Toronto office. And Sean Sadler, partner at the Securities Regulation Investment Products Group, McCarthy, Tétrault, in the Toronto office. We only have a short period of time. I refer you to their detailed bios in the handouts that you have, because frankly they're just too long to read. They're so good. Suffice to say that these 2 gentlemen are experts in securities law and have been around for a while. So let's ask how long that's been. How long have you been practicing?
Since 85.
85, that's a while.
Since 89.
Ah, that's a while as well. So suffice it to say that we have age, experience, and time here. They're melding together to provide what some would refer to as deep insight into our securities law. It is this insight that I would ask them to share with us today. With that in mind, I'm going to preempt my esteemed colleagues here with the typical lawyer disclaimer that we are all lawyers and any views expressed by us today are in our personal capacity and are not necessarily the views of our respective law firms or our clients. Keeping with our conference theme of a change of conversation, rather than get into the intricacies of certain prospectus exemptions, I've asked our 2 industry veterans to discuss the policy considerations involving 3 of OSC concept prospectus exemptions set out in OSC Staff Consultation Paper 45-710. You always have these numbers on these rules. Specifically, the offering memorandum exemption, the private issuer exemption versus the closely held issuer exemption, and the proposed equity crowdfunding exemption. So let me set the stage, and then we're going to have each of them provide some opening remarks. This OSC paper that came out stated that less than 4% of investors in Ontario and the Canadian population qualify as accredited investors. That means 96% of Canadians do not have access to the exempt market. This raises the question of whether the OSC should allow the so-called democratization of investing and open up the exempt market in Ontario. Apparently, there is a growing demand for such access by Ontario investors. From an issuer's perspective, we've heard from some today, Ontario has a funding gap, or what securities lawyers refer to as a prospectus exemption gap. Other than raising money under what is the private issuer exemption from, say, family and friends, one really then goes to the accredited investor exemption. There's this big gap. There's no halfway house as exists in other Canadian jurisdictions. This hurts the Ontario economy and prevents growth. In considering these questions, we have to be reminded of the OSC's dual mandate. We heard about that this morning from the OSC chair, Howard Weston, about protecting investors in fair and efficient capital markets, which I'm sure we'll get into. Therefore, we need to strike the right balance between protecting investors and the cost of regulation. It needs to be proportionate. So with these general comments, I would now ask our panelists to provide us with their opening remarks so we can consider these in the context of 3 very specific exemptions. So Sean, please share with us your thoughts.
Thank you, Brian. With the focus now being brought on the exempt market by the securities commissions, I think it's a very good time for us to step back and look at the type of apparatus we had for many years and what some more recent changes that have been introduced, and adding those together, assess whether the platform that we have in place today makes sense or whether we can further refine. And the other thing that we can look at as we try and apply the right lens is our securities regulation is, of course, focused on investor protection issues, but in this area, the exempt market area, we have a great opportunity to join the global community in fueling Canada's competitiveness, giving our young entrepreneurs an opportunity to bring their ideas to market and compete globally. And because the regulatory apparatus we have today for more mature market participants is very expensive. It's hard to use that apparatus in a way that facilitates creativity and entrepreneurship. So I think we have a great opportunity. It's an exciting time for our capital market regulatory focus, and in the papers that have been circulated, there is data that suggests there's room to grow this exempt market in a fashion that allows more investors, more capital into the system, and I certainly, in my experience, think that those are all fair comments and comments that need to be addressed in our next round of regulatory reform. So just looking back, the way we had it for many years is we had an exempt market, certainly outside of Ontario, that really did not pick up the dealer registration requirement. We had prospectus exemptions, and more recently we have introduced this concept of universal registration across Canada, which is an investor protection mechanism to deliver to the investing community the advice and wisdom of trained investment professionals. But we haven't changed the prospectus exemption requirements that have populated the exempt market. And so we still have principally the accredited investor, the 150,000 K, and the private issuer exemption. And I think it's fair to ask whether those exemptions on the prospectus side really work to the investor's advantage, given that we now have a universal registration requirement in the dealer world. And if we accept that dealers bring good advice to their clients and can help clients discern risk and acceptable investment opportunities, then we can focus again on whether the limitations that are in the exempt market today in the form of prospectus exemptions are fair. Do we really need to say you have to be an accredited investor to participate in some modest fashion in this investment opportunity when you have the benefit of a dealer that's looking at it on your behalf? And I think the corollary of that is that the prospectus exemptions that have been in place for a long time were intended to address the perception that sophisticated or higher net worth or higher income earning people were sophisticated enough to make wise investment decisions without the benefit of say, a financial advisor giving them the benefit of their objective advice. And we've seen, I think, evidence that just because you have higher income or net worth, that doesn't necessarily mean you're in a better position to critically examine an investment opportunity. So I think we can leverage off of these changes in the dealer registration area, use the proficiency and expertise of investment professionals to allow greater participation amongst the investors who wouldn't otherwise be permitted to participate because they're not accredited.
Thank you, Sean. That was very informative. Again, we're setting the foundation for more specific discussions about 3 exemptions. Mike, your thoughts. Where are we going? Are we going in the right direction? Are we there yet?
We're certainly not there yet, but we may be moving in the right direction. Now, I agree with Sean that there's never been a rethink of the prospectus exemptions flowing from largely a requirement to ensure that securities are sold by registered dealers. I mean, I know Ontario brought in the limited market dealer exemption in 1987, but it was never really treated as a real exemption for a long period of time after. When it was first brought in, there was no sense, for example, that a purchaser of securities from a limited market dealer was a client of that dealer. They were no more a client of that dealer than if you hired somebody to sell your house for you. The purchaser's not your agent. Your agent is not the purchaser's agent. They got to go get their own agent. So for a long time, it was really just a way for the regulators to do police checks on those who were operating in the exempt market as a business to make sure that the really scuzzy people weren't in our industry. And it worked quite well. But then sometime in the early 2000s, they started to treat it like a real exemption, and that sort of led to the exempt market dealer world that we're in now. And if you are going to get professional advice from a dealer, whether it's an EMD or an IROC dealer or an MFDA dealer, I think that does change the nature of the prospectus exemptions and the nature of the disclosure that we're going to provide to investors. I think that's particularly true when we consider how unsophisticated a lot of investors are, how little they read the materials that they've been provided with. If you look at the prospectus regime as doing two things, providing disclosure and imposing liability, the disclosure is pretty much useless to most investors. If you look at the mutual fund world, where I think they've done the most research into this, they're now down to having concluded that a 2-page fund facts document written at a grade 6 level is absolutely the most any investor is going to read and have any possibility of understanding. So it really does change the nature of prospectus exemptions if you realize the disclosure part is useless. Or at least it's useless for the investor. It could be critical for the dealers to do their know your product review at a macro level and the know your client suitability review at an individual level. But we can accomplish a lot of that without having a prospectus review by the securities regulators. So I think we're going in the right direction with a lot of these proposals, and clearly the regulators are aware that the world has changed and there is a need to provide funding to smaller, emerging, innovative companies, and we got to find ways to do that. And I think they may have also realized that if you offer investors protection from losing their money, you are also protecting them against getting in on a Google or an Apple at the ground floor, and that may not be fair.
Mike, maybe just for some people that don't know as much about mutual funds, maybe you can explain this switch to fund facts, which is this grade 6 level document that's, as you say, that's out there. What is it trying to do, and why was it introduced in that world? And by analogy, look at the EMD world, where we have OMs sometimes, and some of them are less robust than others, some are prospectus-like than others, and maybe you can draw an analogy.
Sure. I mean, it was a long evolution from a standard long-form prospectus through what they called a simplified prospectus, which came in the 1980s. And the concept there was that the simplified prospectus was only the most critical information that an investor needed to make a decision in the mutual fund. Behind that, there was a longer disclosure document called an annual information form, which was not necessarily given to the investor, but was made available on request. And over the years, more and more information got loaded into the simplified prospectus as every regulator had their own views as to what was critical information that had to be provided. And some years ago, they came to the conclusion that that wasn't working either. Nobody was reading the simplified prospectus any more than they read the long-form prospectus. So they've now developed a 2-page document that they call the fund facts document, which is supposed to be the key features that every investor should know about before they actually make a decision to buy. And it's, we're moving to the point where that will effectively be the prospectus. There will still be a simplified prospectus, there'll still be an annual information form, but the only document that the investor will need to be provided with and on which it's assumed that they will make the investment decision to the extent they're making it and not their financial advisor will be a 2-page document.
Thanks. I know in prospectuses, dealers share amongst themselves a document called a green sheet, where it's kind of the skinny on the transaction. Okay, gentlemen, let's get into our first exemption, the offering memorandum exemption, the OM exemption. It's available right across Canada except here in Ontario. I got to ask this, so you're going to indulge me for a moment. Put up your hand if you think that Ontario should adopt the OM exemption or the form of the OM exemption. Straw poll here, okay. Thank you very much. I'm now going to quote from the OSC, a famous author of the OSC who shall remain nameless. Actually, I'm quoting from their paper. And I want to kind of leave you at, or start us with, their comments about the OM exemption. They did not adopt it, and they said that in their report that came out in December. So they were concerned that receiving a lesser form of disclosure document, we talked about disclosure, is not an acceptable alternative to the prospectus regime, particularly if the issuer is not a reporting issuer and no continuous disclosure is available. And the OSC further stated that both models of the OM exemption may place investors at risk, as the offering memorandum is a non-vetted prospectus-like document provided to non-accredited investors who may not have the ability to withstand financial loss. So without getting into the details of the OM exemption, there's two basic models. There's one is called the BC model, where you have a prescribed form of offering document and a risk acknowledgement form, and the public can invest. Alberta's the same form, except it's limited up to $10,000, where if you're going to invest more than that, you have to be an eligible investor, which some people refer to as a baby accredited investor. That's the regime. So with this background, Mike, what do you think about the OM exemption? I know the OSC has proposed something. I know the EMDA, we refer to it as crowdfunding 2, not really getting to us what we really wanted here in Ontario. What are your thoughts?
Well, I agree that what's proposed now is basically paper crowdfunding, and I don't really know that that's the way we want to go. I don't think there's anything wrong with having an OM exemption along the lines of Alberta in particular. If you look at what does a prospectus give you, it gives you a prescribed form of disclosure document, which the OM exemption also requires. The prospectus provides for sort of pre-closing, pre-trade vetting by the securities commissions. The OM exemption would not provide that. But I think we have to remember that basically securities are sold off a preliminary prospectus, which isn't vetted by the commission before it's handed out to people either. So I'm not sure it's significantly different. Third thing a prospectus gives you is statutory liability for the disclosure. Again, the OM exemption provides the same thing. I guess the fourth thing that it gives you is, generally speaking, sales through registered dealers. And I think that is something that we should think about, whether, you know, an OM exemption which doesn't have all the limitations on it that the OSC is proposing, but which is nevertheless sold through registered dealers, might not get you a much better prospectus exemption. And then I guess the final thing that a prospectus exemption gives you is statutory liability on the dealers who sign the prospectus. But again, not all dealers that sell a public offering are signatories to the prospectus. And I don't think we want to go there, because I think that would, at that point, you might as well file a prospectus. I think you've taken away all of the cost benefits in not having a formal prospectus.
Right. So, Sean, should Ontario adopt the OM exemption? Is there too much risk to the public? Why is Ontario the only Canadian jurisdiction not to adopt this exemption? Will this satisfy the funding gap? Sean, can I ask you any more questions than my single question here?
Maybe I'll start with the last question about how the OM exemption will address the funding gap. The gap that we call the funding gap can be lined up with another gap that I think is related and certainly needs to be examined at the same time, and that's the financial literacy gap. And the OM, the prospectus, as Mike has outlined, are documents intended to facilitate improved financial or investment literacy, but also, as Mike's pointed out, certainly in the mutual fund world, the regulatory admission is that the long-form prospectus didn't really help, the simplified prospectus didn't really help, and in due course we may find that, hey, no one reads the fund facts either. So in fact, what I think we have to perhaps accept or appreciate is that, just like as the axiom in the mutual fund world that mutual funds are sold, they're not bought, the same is generally true, in my view, in the securities world. And investors are simply not going to reliably inform themselves about the risks of a particular investment. Some will, but a good number of them will not. And if our regulatory apparatus is premised on a structure that's intended to tell investors all about this investment so that they're informed and can make a wise decision, I think we're doomed to fail. And so what makes sense, in my mind, Brian, is the OM exemption, if we embrace it, and I think we should, in the form that's in the westernmost provinces, is that it needs to be supported by good advisor advice. The OM itself is not going to help the investor. They need the benefit of someone holding their hand and telling them whether this is a good investment or not. So why have the OM? Well, why have a prospectus? Well, it still serves a purpose as a liability document. That is, it puts the issuer to the test of disclosing so that investment professionals can at least follow what the attributes of the investment are. So I think it's a good idea to have the disclosure, but I think it's really there for liability purposes and to allow investment professionals to vet. Sorry, Brian, you had a couple more. Why did Ontario not follow
we
this?
started off with a quote which was in the OSC's paper, and this is kind of a statement in terms of whether it's a current or historic view from the OSC in terms of the OM exemption. I know they have some form of it proposed, but if you look at the policy levers, the EMDA, we've been promoting what we're calling an eligible investor exemption. It's based on the Alberta model, but we believe, as you're saying, that there should be a dealer involved and there should be public posting. Do you think we should try to get it right in Ontario and just move forward with some version that may be more onerous than the other jurisdictions, just to move forward, and then we can worry about harmonization later?
I'm a fan of harmonization. There's all kinds of different views on this, but I'm very sensitive to the cost to issuers and dealers that are trying to raise capital in Canada and get stymied or frustrated with the cost of complying with different requirements in different jurisdictions. It adds a lot to the legal fees. That's great for folks like Mike and us, but I really think it's a shame if we can't make reform in a harmonized fashion, or we're just not serving the interests of the investors and issuers. So I'm not in favor of pushing ahead in an uncoordinated fashion.
How about yourself, Mike? We push for harmonization. Should Ontario go it alone just to say we have an OM exemption, and then we can worry after the fact, once it's in, of how to get everybody on board? Because if you strap on all these other protections, is it victory just to get it happening so we can improve capital raising in Ontario, or should we slow it down and try to bring all the CSA members on board in terms of one harmonized version, whether it's BC's, Alberta's model, or whatever Ontario would propose?
I think the risk of bringing something in Ontario is that they'll think it's done and it'll be years and years before the issue gets revisited. I'd be more of a fan of trying to get it harmonized and get it right and get it harmonized from the beginning, because for a while we were actually making great strides on harmonization, but lately we see more and more that the different regulators are prepared to go it on their own, and I'm not sure that's positive at all. One more just sort of caveat on the OM exemption, though. I mean, I think that if Ontario starts looking, as they will if this exemption becomes available here, at the products, they may not be very happy about all of what they're seeing. Some of the ones I've seen have had extraordinarily high fees, sales commissions, offering costs being deducted. Somebody came to us with a proposal that would have had 46% of the gross proceeds go to pay commissions and offering costs, and we refused to work on it on the basis that we weren't going to lend our name to a product that was that high. But there's certainly lots that are very, very high, and I think that as an industry, if this thing comes into Ontario and you guys as dealers start selling it, you're going to get a lot of awkward questions about how could this possibly be suitable for any client, given the level of some of the fees that we're seeing. I'm not sure what your experience is with these sorts of things, but I mean, they're all over the map, but I have seen some that I would say are outrageous. And when you add that to the sort of regulatory focus at the moment on on fees in the investment fund area, which are supposed to be outrageously high. I think that you're just going to get more issues from the regulators if you're not careful about the products you actually sell under the exemption.
I think that's a really good point, and related to that is, as we've seen, the regulator is focused on fees, and I think a theme that we may see more in that regard is who's paying those fees. And in order to serve the investor in giving objective investment advice, there's certainly a tendency on the part of the regulator to expect that investors should pay those fees and not the issuers themselves. And our private placement market, has grown up over the years with a lot of the fees being paid to placement agents by issuers, and which is fine, and it should always be thus in terms of the services that are being brought to the market by the intermediaries acting for issuers. But if we accept the fact that investors are on the other side of that, they need protection, the folks looking after them should be, in the regulator's eyes, perhaps paid for by the investors. And so I see that as a theme that will continue, and we should be ready to deal with that.
Let me ask you both about the level and quality of disclosure. I think we're seeing it all over the map. And I think the concern here, and this is maybe we'll set up for part of our discussion on crowdfunding in terms of disclosure document. You start off with you have to have a prospectus unless it's exempt. Other than the OM exemption, people have various offering documents that are defined as an OM under Ontario securities law. If we look at this disclosure document, that's a prescribed form. It's too simplified. It's wrong if issuers just do it without the assistance of counsel or otherwise. If you get lawyers on it, you get a prospectus. What are your thoughts in terms of what is the alpha of an OM? How can we get it right? Is it just some concept that the regulators think the perfect OM exists and we have these rules that we're supposed to read? How would you suggest that industry or even the regulators approach, despite having in the OM exemption prescribed requirements?
Well, Brian, we have sort of two OM worlds right now. We have the approach for the OM exemption in BC and Alberta, which has the prescribed form, which is analogous to what we have in the prospectus world. And then we have what we do in Ontario, and we're guided by the definition of misrepresentation. We just don't want there to be a misrepresentation. It's a very broadly cast definition. It's not just making an inaccurate statement, it's omitting to make a statement that is necessary in light of the other statements that are made. So we end up having a document, as you say, Brian, that looks a lot like a prospectus. I don't feel strongly which way we go, whether we should introduce form requirements for the OM or continue with the Ontario approach of trying to avoid making a misrepresentation. Because, as I said before, I don't think anyone reads this stuff, at least the investors don't read it. And so it's principally there for a liability document. So it's there for issuers to cover off their risk of being sued for damages or rescission, and it's in their interest to do a good job at it. But I don't think it's going to help the investors one way or the other.
I'm not a big fan of the OM form of offering memorandum. I think that could be improved a whole lot, just in terms of the order in which the information's presented, the duplication, other things like that. But Sean, I mean, there is a difference between an OM in the Ontario model, which if you choose to talk about a topic, you better get it right. You got to provide all the relevant information, but you're not necessarily required to talk about every topic versus a prospectus, which does have to have full, true, and plain disclosure, in addition to that full, true, and plain disclosure not containing misrepresentation. So I suspect that we may find that some of the disclosure model is pushed more towards the prospectus, full, true, and plain disclosure, as a condition of getting some of these exemptions available purely for liability reasons, to make sure that the full story is out in the document and that someone could sue on that if that's wrong, as opposed to being able to say just leave out the tax attributes and put a statement in, get your own tax advice, whereas a prospectus, if it was material, would have to include the tax advice. So my bet is we're going to see more documentation towards the prospectus model as a condition of getting expanded prospectus exemptions.
Okay, thank you, gentlemen. I think we will briefly come back to the OM exemption because it kind of fits into crowdfunding, and we'll explain that. But let's move on to another exemption, the private issuer exemption versus the closely held issuer exemption. We presently have a private issuer exemption. You can't distribute, allows non-reporting issuers to distribute securities to 50 people, excluding certain people like employees who fall within certain categories. For example, directors, officers, close personal friends, close business associates, accredited investors. The key in this exemption is investors are generally thought to have some sort of relationship with the issuer that allows them to make some sort of investment decision based on trust, familiarity, etc. We used to have here the closely held issuer exemption. Simply put, it was a kind of a lifetime of the issuer exemption when you can raise up to $3 million from up to 35 investors, the so-called public. So just to get the facts straight on the private issuer exemption, you have to fit in with these specific categories. Like an easy one to explain is you can't be a friend of a friend. You have to have that degree of relationship, let's say with an officer, director, or others. As opposed to the closely held issuer one, it's the public, it's 35. So the OSC raised this in the paper saying, what's industry's thoughts? Should we replace one with the other? Do you keep both of them? And Sean, what's your experience with one or both of them? I was kind of made fun of the fact that you had a discussion with the OSC about a friend of a friend, or someone's not a friend because they're not of close enough proximity, and then you have to call them up and say the OSC said I have to take you off my Christmas card list or something like that. Sean, so what are your thoughts on these two exemptions?
Well, it's been a while since I worked with the closely held exemption, but my recollection is that the clients liked it. It worked. They could eventually get frustrated once they achieved the success of the capital limit of $3 million, but it worked well. And the private issuer exemption, I find clients really like it. I like it less, not for any good reason, but I have a hard time giving crisp advice in some cases as to whether they're entitled to rely on that exemption because, for instance, who is a close personal friend of so-and-so? It's just very difficult to comfortably advise a client that exemption is available, and the area of exemptions generally should be defined very precisely and prescriptively. So I'm a fan of prescriptive exemptions that are clear. It's easier to protect clients from perhaps regulatory action. So I certainly see the private issuer exemption as working well for issuers. Clients like it. It has some other advantages in terms of post-trade reporting and fee paying. And so I wouldn't want to necessarily disrupt it, but if I had a shot at revising the drafting, I'd like it to be a little more prescriptive. I don't have a problem with it sitting alongside the closely held issuer exemption either. I again, though, query if we're looking at all of this afresh, would want it all looked at carefully and considered in light of whether it could be interest served by having a dealer give advice to the investors, because that's where there's a chance of really helping investors.
Thanks. Mike, your thoughts, please.
I guess I see the exemptions as coming from different places. And I think if you go back before the time any of us practiced law, we had a concept of distribution to the public as what securities law was supposed to deal with. And that was because there was a basic thought that private transactions ought not to be regulated by public securities laws. And so we gave up that whole concept of distribution to the public, not because we disagreed with the concept, but because, just as Sean said, it's so darn difficult to figure out who's the public and when you were caught by the rules and when you weren't. But we've always then kept the concept of a private issuer, which is still, still the same concept, that, you ought to be able to get together with your family and put together a business without having to worry about, registration and prospectus exemptions. So I would be a fan of keeping that one. The closely held issuer exemption, I think, is trying to achieve a different effect. It's what we've been talking about. It's crowdfunding. It's OM. It's how do we open up the exempt market to issuers who need to raise capital but can't afford to access the public markets through a prospectus, and investors who want to participate in something like that. So I would also be a fan of having both, with the caveat that after we've looked at all the exemptions, we may find that we don't need all of them if they're trying to achieve the same thing.
As Sean said, a lot of time, money, and effort gets spent on analyzing, if it gets spent at all or looked at, in terms of the nature of the relationships, especially, let's say, if the OSC does a field review. And that's where some have said, this is just an interesting exercise. I now have to justify to the regulator why someone is a close personal friend, and it's a mug's game trying to figure that out or not, arguably, or maybe it's pretty clear that it's not. And that's why some have looked at the closely held issuer exemption. It's just crisper, it's cleaner, just 35 members of the public, et cetera, and off you go, and it's a lifetime exemption. But those are interesting views. Now let's move on to our third and final topic, being the crowdfunding exemption. Jeff, how are we for time? Okay, great. I'm not going to get into the details of crowdfunding, other than I just want to set the stage for a few key concepts in order for us to engage in this discussion. There's different models. I'll just call it non-equity and equity. We're talking about equity crowdfunding. Some of you may have heard of Kickstarter, Rocket Hub, Indiegogo. People are doing campaigns. They have people that are contributing. They get rewards, or you pre-purchase something. That's not what we're talking about. We're talking about selling securities on the internet. That is what this is all about. We are talking about this because on April 5th last year, the Jobs Act was passed. Title III has set a framework for crowdfunding. So just some basic tenets, just so you have some of the concepts, not all of them. We have to look at three players or three areas in this: the investor, the portal, and the issuers. In terms of the proposed framework, investors can't invest more than $2,500 in any single transaction in any 12-month period, up to $10,000 in any 12-month period. They need to get an offering document called an information statement. They have a 2-day cooling off period. And some of these things you'll look at and say they sound familiar, like the OM exemption, and they are. They're meant to be. They are there to protect investors. In terms of the company, they can only raise up to $1.5 million in any 12-month period. They can be sued for misrepresentations. You don't have to have audited statements if you're raising less than $500,000. There's some relief there. I won't get into the other complexities. In terms of how this entity, this portal, will be regulated, that's not known. There's various models of how to sell securities over the internet. Some of you may, in the States, have recently heard of some no-action letters with Angel List and Funders Club. Completely different than what we have here, even though some people are calling that crowdfunding. It's not. It's really selling to accredited investors in a certain U.S. structure. So, and gentlemen, please get into some of the details of crowdfunding. The blunt question is, should Ontario adopt crowdfunding, Sean?
I am supportive of it. I think it's a novel idea. It's, when I first saw the jobs legislation and understood what it meant, I thought of, Dodd-Frank as this rushing river going down towards the sea, and then this crowdfunding proposal is releasing some spawning salmon to go the opposite way. It cuts against the grain of what we're seeing in Canada of stepping up the dealer registration and the role of the registrants in protecting investors. They're sort of absent here, and I'm generally a fan of what dealers can do for investors and the potential, at least, of what they can do, and this doesn't do that. But I do think it you know, if you have the protections of modest investment limits for individual investors and other criteria that have been outlined in the jobs and in the CSA proposal, I think it's viable. I wouldn't, but I would regard it as experimental. I'm just not sure how it's going to work out. But I think in the long run, it is inevitable that securities will be sold very routinely over the internet. I just don't know right now how that's going to shape up in the future, and maybe this is the first step of finding out.
Mike, your thoughts, please.
Much along the line of Sean's, actually. I think with modest investor levels, there's no reason not to allow it. I think that at least for a while, it will have aspects of the non-equity crowdfunding. I think people will put their money into things that they think are fun or interesting or deserving, and I don't think there's anything wrong with that at low levels. I'm not sure why you'd impose a $1.5 million level on the issuer. That seems pretty arbitrary, and I'm not sure why it's needed, and I think I'd want to see what the actual regulation for these portals was like to make sure that it was in fact a viable regulatory regime, but on the whole, I'm in favor.
So you mentioned in the U.S. it's $1 million. There's complaints that this is too low under their regime. 1.5 here. Your thoughts on that point you just made? Should it be higher? Should there be a constraint on the issuer?
Yeah, exactly. I'm not sure what the reason is for constraining the amount of money an issuer can raise. Like at $2,500 maximum a person, you are going to get a lot of people before you hit the 1.5 million.
600.
Yes, if you say so. But and once you're at 600 investors, why not 1,500? Why not 3,000? I mean, you're a long way from the private company exemption at that point. So I don't know why 600 is a magic number. And not everybody's going to put in 2,500. So you probably got a couple of thousand investors.
So I guess looking at this crowdfunding exemption, in the OSC paper, they basically said their version of the new proposed, a concept of a proposed Ontario OM exemption would be to be the same as the crowdfunding model, except there's no necessarily requirement to have a registrant or a portal operator. Thoughts, Sean? Is that good enough? Do you understand that? Do you feel that this was an afterthought, or do you think that there really is some thinking there that maybe we're missing?
I think it's something we should act on. We should do it. I agree with Mike. I don't see the wisdom of putting a limit on the capital raised by the issuer. Maybe there should be some limit, but it should be higher than it is, because I just don't know what 1.5 million will really allow an issuer to accomplish in today's world. If they have concerns about what those issuers might do with the money, there are other ways of, saying that a certain percentage has to be spent on particular components and shouldn't be going to salaries and things like that. So I think there's ways we can deal with that, but I would not constrain the limit of the raise, at least not at low levels that are proposed. And I think that it makes sense that portals be subject to a registration requirement so that there's some basic facilities available to make sure they all work, and that there's a level of functionality that meets the investor and regulatory expectation. But I'm keen to see how it all works. As I said, I'm convinced it's the way of the future, but we're in new ground, and we're going to have to tinker with it.
Real quick question: if there needs to be a focus here on these very different concepts out there, they've also looked in this concept paper of some other proposed exemptions, which I won't get into. But my threshold final question for you gentlemen is, of all these exemptions, which one should we focus on? Which one's going to move the needle here? And basically allow more capital to be raised, stimulate the economy, create jobs. I know we don't change regulations to suit our economic conditions. Regulation is regulation. But because these are out there, which one in your mind should be ranked 1, 2, 3, or otherwise, Mike?
Well, I think if you had the OM exemption without a $1.5 million limit, I think that would generate the most amount of useful capital. If you're going to impose low levels on issuers, I'm not sure it makes much difference which one we go first. I think at that point you kind of need them all.
So if we take away this crowdfunding 2 version as was proposed by the OSC and look at the existing OM exemption to going what we started with, your thoughts on that one in terms of...
I think that would be by far the most useful one for issuers to raise a meaningful amount of money.
And you think, from your earlier comment, that better to work within the CSA to try to get it right, even though we've all been waiting so long and no one wants to wait any longer to open up that door there, get it right, or just...
Yeah, I'm just concerned that once they bring it in, that's off the agenda for 5 or 10 years before it comes back on. So.
Okay, thank you. Sean, final comments?
I agree with Mike. I think the OM exemption has the most promise. I do think that if we're trying to fix it for the long term, it will be important to involve the dealer community in acting for investors exclusively, so it's very clear that the investor is getting objective advice in connection with this exempt market purchase. And that requires us to examine how the folks are being compensated. And I do think it's very important for the young issuer community to have harmonized laws. Otherwise, it's going to be too expensive to cope with all this. And we will see form shopping, which is not good for either issuers or investors.
Gentlemen, thank you very much. Thank you, everybody.
Thank you.